You might have heard Apple Savings is paying 4.15% on their new savings account, which begs the question, does infinite banking still work? Stick around and find out.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Anthony, like we mentioned a minute ago, Apple has now come out with their new savings card, and they are offering 4.15%. A lot of buzz going around about this high-yield savings account, which we've had, a few, right? Not a lot, but we've had a few clients that have questioned and said, hey, does infinite banking still work in this scenario?
Yeah, we're getting those too. And I mean, we're going to go deeper into the details, but the bottom line is infinite banking is much more than rates of return. We're just using the product of whole life to store our money. But what we're going to do is kind of compare. We got to store our money somewhere.
Yeah.
So we're going to compare some of the differences between these high yield savings account and particularly Apple, because that one has a little more buzz.
Oh yeah.
Compared to a whole life.
Yeah. So real quick, as we kind of go through this, we've made some main differences kind of between the two of them. So we're going to highlight those, and then we're going to talk about one of these accounts kind of specifically. But some of the main differences that came to mind is when you're looking at a high yield savings account, right? Those returns are taxable. We get money inside the policy that is going to be a tax-free account. And then also the ability to collateralize or to borrow against it, which I think is one of the paramount reasons why we're even using whole life insurance, is because of those loan provisions. So don't forget those. And then also, if you look at it, man, in my opinion, the Apple Savings Card is a feeder fund for their credit card. I think we're going to touch on that. And as opposed, right, the way that I view our policy is it's an opportunity fund, right? We've got cash protected and we can act on any opportunity that kind of presents itself. So those are really the big differences there. Anthony, you want to touch on kind of the high yield savings account that Apple's offering?
Yeah. Before that, you mentioned the taxes. So I got to add a little something in there, because again, if we're comparing rates, what we would say a whole life policy will run about 4%, right? And these high yields about 4%. So you might think it's the same, but when you got to take into account the taxes. Because of the taxes, let's say you're in the 25% tax bracket, right? Or you might need to earn 6, pay Uncle Sam and the state to equal 4. And it's even more if you're in a higher tax bracket. Not only are you paying a higher tax rate, but also there's an additional tax on investment income, a Medicare tax at 3.8%. So we're going to talk a lot today about not focusing on the rates, right? We need to focus on the bottom line. What we did with this Apple high yield savings account, we actually looked into some of the details and the fine print. And if we look at it, we just FYI, Apple is not a bank.
Yeah.
Right. So they're partnering with Wall Street darlings, Goldman Sachs, right? Which always provides some comfort, right? But if we look at the fine print, in order to get this high yield savings account, you have to qualify for it because you need to obtain an Apple credit card, which means that's going to weed some people out because maybe they don't have a good credit, but also there's no minimum, which sounds great.
Yeah.
No fees. Sounds great. But again, you look at the fine print, it's a variable interest rate. So you got the 4.15 now. What's that going to be like in a year or 2 years or a month or 2 months? Also, they limit how much you can have in there. The most you can have inside that Apple savings account is $250,000. Okay. And I don't know if you listen to the news, but Banks are showing some concern of their safety if FDIC is going to continue to bail out these banks. So there should be some concern there. Now, again, as I'd mentioned, you have to qualify for that credit card. Now, the interest rate on that credit card is between 15 and 26%.
Yeah.
Let's just say of an average of 20%.
Mm-hmm.
Now, let's take a little time to kind of really look at how banks make money, and particularly using the Apple high yield savings account.
Yeah, let's take a look. Anthony, when we take a look at banks, I actually didn't listen to anything you were saying right there. I was thinking about what I was going to say.
Mm-hmm.
And this idea, right, of looking at kind of how banks work actually came up with a pretty good analogy, I think. So on the Starbucks, they have a logo, and it's a siren. A siren's like a mermaid that sings. It's a folklore, it's a myth. But what it would do is, the story was that sailors back in the days, they'd be out at sea and they'd hear this beautiful voice,
Mm-hmm.
and it would lure them into shore, and they would end up hitting rocks, and the ship would break and they'd end up dying, right?
Mm-hmm.
So it leads you to disaster. Very misleading. And that's the idea that I thought of when I was looking at how banks work, and how what Apple is doing by kind of teasing you with this 4.1% interest rate is that they're luring you in to devastation and financial ruin.
Oh, dang!
I know that was pretty extravagant, right? But so here's exactly how banks work. Hopefully we can be sharing our screen here, and we'll take a look here. Awesome. All right. So if we take a look, this is my beautiful drawing of really kind of the banking equation. In every banking equation, you have the bank, and you have a saver and a borrower.
Mm-hmm.
Anthony, I got a question for you. Which one are you? Are you a saver or a borrower?
Well, I kind of know the answer.
You do, right? Yeah. Typically, when we ask somebody, when we're teaching them how banks work, is somebody will either say, "Hey, I'm a saver," or "I'm a borrower," or a spender, right?
Mm-hmm.
In reality, we're all the same, right? We save to some extent. We also borrow or spend to some extent as well. So if we look at this, is in our example, I'm going to draw a great example of a saver, but in this situation, right, we have a gentleman. He's got $10,000. And what he's going to do is he's going to come down to the bank, and he's going to put it on deposit. What's the bank do with that money? What does the bank entice him with, right? Traditionally, up until this point, banks have paid really zero, right?
Mm-hmm.
I'll say 0.1% on savings checking accounts. And really the benefit of using a bank has really just been convenience and liquidity. And what does the bank do with that money, Anthony?
Don't they just store it in the vault waiting for you to withdraw it?
Yeah, exactly. Like Daddy Warbucks, right? They just put money away. We all know that's not exactly how banks work. Banks return and they cycle money through. So when banks take a dollar on deposit, or 10,000 in this example, they're going to turn around and they're going to go find somebody to lend it to. When they do that, they turn around and they will charge an interest rate to that individual. So now that individual, the borrower, needs to pay back the principal, what they borrowed, plus an interest rate. And really what we're looking at in this example is this is what Apple is getting into. Apple is putting themselves kind of in this position. They're partnering with Goldman Sachs, and they're enticing people, right, to put money on deposit with a 4% interest rate. And then they're going to turn around, and when they borrow money, they're going to charge them a 20% interest rate. When most people look at this scenario, they'll look at it and they'll go, all right, no problem. The bank, right, is making 16%.
Right, 20 minus 4.
20 minus 4. Anthony, is that true? Is that really kind of how this thing is going to work out for us? No, right? If you do the math, the bank is not making 16%. The bank is making 20, they're paying 4, and so they're actually making 5 times the amount that the individual is making, which translates to 500%. So when we talk about banks, right, the way that banks work, this is exactly what they're doing. And Apple is getting into this front side of it. They're enticing people to put money on deposit. This is exactly why I called it a feeder fund for their credit card, right? Is they're putting money, they're enticing people to put money on deposit with them. And then the trap, right, is they're going to have a whole bunch of people that are going to fall prey to kind of using their credit and charging a very high interest rate. And again, I don't think it's any exaggeration by saying that this could lead to kind of financial ruin for some people as they don't manage their credit cards very well.
Mm-hmm. Let me ask you, who, if you're listening, who would pay $4 to get back 20?
Well, I would.
Okay, good.
Absolutely,
I mean, me. Yeah, please. I would love to, but that's an example of how banks work. I'd have to surprisingly say, well done, Cameron. And if you're listening to this, we also post this on YouTube. So on YouTube, you can see this beautiful drawing that Cameron did. And he actually did a stick figure, which I'm a little disappointed. Normally your drawing, of course, has that silky smooth hair, but I know time is of the essence here on this podcast. But now let's dive. So we talked a little bit of how the high yield savings work. Let's talk a little bit more about how whole life compares to that. And if we're looking at whole life, for one, we talked about the taxes, but we're going to dive a little bit deeper, meaning that there's a minimum interest. There's a guarantee between you and the insurance company of an amount of cash value that they're going to pay you in interest. There is no minimum, or maybe outside of zero, at a high yield savings account. There are no limits on deposits into whole life. You can have more than $250,000. Again, you just need to qualify for the death benefit, and there is no limit on those premiums. Now, also, whole life is going to follow interest rates. As interest rates are low, then dividends from the whole life is going to be low. And what we're looking at now, we're coming out of a historically long period of a low interest rate environment. Which is interesting. We're looking at whole life really at the worst point, right? At the lowest level, and we're comparing it to a savings account at one of the highest levels, right? Which isn't a fair comparison because whole life follows interest rates. Now, interest rates just shot up. So what I do expect to see is that next year that dividends will increase. Also, one thing we didn't talk about, that every state has some level of asset protection for the cash value of your whole life. Some states like Nevada, Texas, Florida, and New York, 100% protected. You're not going to have that asset protection from a high yield savings account. Cameron, you were going to tell a story.
Yeah, when we're looking at cash value and whole life insurance, honestly, I don't think we do it enough justice when we don't talk about anything other than cash value. Right. And the message today is it's more than just rates. And so what came to mind was really two conversations I've had recently that wasn't about the cash value or about the rates. One of them was I was talking with a client, and her husband had recently passed away, but she said she was reading her policy, and I was almost embarrassed when she goes, "Hey, there's a section in this policy that talks about terminal illness rider. Like if I get sick, like I can access the death benefit." And I was like, yeah, that's exactly right. Right. And I was like, the next 2 pages talk about kind of a chronic illness rider. And so we talked about some of the benefits of that. And so oftentimes, right, we don't talk about those types of benefits that are some of the living benefits in addition to the interest rate that you're not going to find in any sort of other account. The other one that came to mind was,
well, Carol, what is a chronic illness rider? Since you mentioned it, what does it do? And how much does it cost? Because I actually got an email in my inbox asking somebody how much that rider costs.
So there's 2 benefits that I just mentioned, a chronic illness rider and a terminal illness rider. They're both very similar, but for different purposes. A terminal illness rider is that, hey, if you get diagnosed with a terminal illness, right, you get a doctor's note that says that you're terminally ill, which is usually 12 months or less. You can turn that into the insurance company, and you can actually draw on a portion of your death benefit. Usually that's up to about 50% of the death benefit or 50% of the total amount of death benefit at risk, right? And so you can draw on that for just quality of life, right? So as you live out that remaining year, right, you could go on a trip, you could use it for treatment, you can do whatever. Same thing with the chronic illness is that you get diagnosed with a chronic illness rider. you can enact that rider and you can draw on a portion of the death benefit. I will say in that one, actually in both of them, if you draw on it, you do pay an interest rate, right? So I think that interest rate is 8% when you draw on that. That is a short-term loan typically on the terminal one because you're looking at end of life. But that chronic illness, there's some ways you want to make sure that you address that. So those are great benefits. Very rarely do we talk about that, but they are there kind of in the background available for someone if they unfortunately find themselves in that situation. Yeah. The other story that kind of came up was I was a client that was discussing kind of high yield savings accounts and was considering whether he should pay a PUA payment or leave the cash in kind of a high yield savings account. And one of the things that came up was, well, Jim, what are you going to do? And he's like, well, I'm going to pay the PUA rider, of course. And I said, well, how'd you come to that conclusion? And he's like, well, because there's a death benefit that comes along with this payment and this policy that I don't get in this. And he's like, and you know what? My wife will be pretty happy to know that her death benefit is not going anywhere. So again, right, those are ancillary benefits to kind of what we're doing. We're so focused on cash value is that sometimes I honestly feel bad that, we don't do it justice in talking about some of those other living benefits.
Well, so with a high yield savings account, Cameron, do you feel that there is a place for it?
I do. Yeah, there's certainly a place for it. What I would tell somebody is that most of the time, I think I've shared this before, but I usually keep kind of 2 months of expenses in a checking account, and then everything else kind of gets swept out and I keep it in policies. So in that situation, depending on where someone leaves their money or kind of how they have their money flow in and out of their account, they could certainly use one of the high yield savings accounts to just bolster some of the returns there. I would say I'm not a big fan of the Apple savings card because it is tied with that credit card. There's probably 4 or 5 other high yield savings accounts that we looked at that don't have that type of requirement. And so I would recommend you consider one of those if that's something you want to do. So there is a place to a minor extent to use those high yield savings accounts for sure.
Interesting. I have a much different take. I would say, again, if you can do infinite banking, I don't think there is a place for a high yield savings account. And the reason I'm similar. So what I did is get prepping to answer this question. I looked at one of my bank statements for my savings account. To be honest, I don't know the last time I did. Right. Because it's sent electronically. I don't even look at it.
Typically you don't want to. You're correct.
Right. Yeah. But I looked at it. I'm like, oh, I want, what's the interest rate going to be? And you know what it is? Like I first looked at it, I thought it was 2%, which, okay.
Yeah.
It's not as good as Apple, but it's 2%. But my eyes are not the best. I had to look a little closer. It wasn't 2%. And it wasn't 0.2%.
Oh no.
It was 0.02%.
Yeah, your eyes are bad.
Okay. Now, and it's small font. Okay. But I'm going to tell you, I'm not going to be tempted to put, for one, I'm with you with Apple. I don't want another credit card. Yeah. Again, I need to manage my credit score, and I'm not going to just have that hindered and get that inquiry. And then also now that changes like the length of the credit that I have outstanding. So, but even if another high yield savings account somewhere else, I don't keep a lot of money in there. I only keep 1 month in there. Everything else is swept into my policies. So for 1 month, having that additional, again, we got to look at the rates, right? And we look at the actual, we got to look at the dollars.
Wow. Yeah,
right?
Exactly.
Yeah.
Let's record that.
Well, no,
the whole message is it's more than just rates. And you end with that.
What I think that shows is kind of what we're taught. Like it's so in there, so deep that even with experience and prepping with this, we still have a Freudian slip here. Oh, yeah, that's true. That's true. Gotta look at the dollars amount, the dollar of the benefit that I'm going to make by switching. First of all, it will be more having in a high yield savings account, but again, it's going to be taxed. So it's not going to be as high, but I'm also looking at convenience. For me, just having I only have a small amount, so it's not a big deal. And the inconvenience of having to move money around, the juice isn't worth the squeeze for those extra dollars. But the bottom line here, let's wrap this up.
Please do.
Okay, right. Now, we talked about all of these benefits, and we're comparing products. Now, for one, a couple notes. For one, we're just comparing products and the advantages of having money inside the whole life policy, and why we use whole life, because we can leverage against it, which means you can borrow against your cash to buy investments, where it's a down payment on a car, or whatever your investment of choice is. It could even be stocks or investing in your business. But the thing is, we never withdrew money from your account. So your money inside your policy is going to continue to compound. And if we're really doing a true comparison between a high yield savings account and whole life, we got to look at the whole picture. It's not just about the cash value, but when we incorporate infinite banking, we're going to leverage that cash value to buy assets. So you really need to look at the seen, and I like to say the unseen of infinite banking. Mm-hmm. The unseen is what you do with the policy, which is hard to really articulate what you're going to do. But if you're practicing infinite banking and you're implementing our recommendations, you should have more assets outside from leveraging your policy than you do inside. So you're going to have a lot more than just a cash value. But we're going to end it on this note, Cameron.
I know. I'm excited to hear this.
Okay. In summary, or more with Infinite Wealth Consultants, we don't sell life insurance. We teach infinite banking.
Well said. Hope you guys enjoy this episode.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.